Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
My long-term maximum gain, as I mentioned, is unlimited. If you're fortunate enough to have your near-term option expire worthless, then you're long a January or a call option for March. It has unlimited upside. So if the currency skyrockets, you can make an unlimited amount going up. Your maximum loss in the near term is about 550, and your maximum loss in the long term is also 550. So the margin requirement on this trade is simply the debit to go into it. It doesn't matter who your broker is. Chances are pretty good that if you put on this trade, and in this example, it's a 1-by-1, so it's easy math, it's going to cost you $550. If you can afford to buy this spread for $550, that's the max loss. You don't have any additional margin requirements on that. All right, let's move on and look a little bit further here. Here's a second example, same currency, but instead of choosing a 140 call, I decided to choose a 130 call. Now, you might say, well, why would you choose a 130 versus a 140? Well, look at my direction. My sentiment is a little different here. In the long term, I'm still bullish, which is why I'm using calls. But in the short term, on my first example, I was either neutral or only moderately bullish. In my second example, I'm neutral or actually moderately bearish. So let's say I thought that the dollar was actually going to lose a little ground against the Australian dollar in the short term, but then pick up and get bullish in the longer term. I want to have, again, if you look at the chart, you can kind of see that ideally where you want to be at the near-term expiration is at the strike price. So if I'm at about 140 when I put the trade on, which I am in this example, in the previous one, 140.26, what I want to do in choosing my strike price is think about where do I think this index is going to be at the near-term expiration, and that's the strike price that I want to choose. In my first example, I thought the index was going to stay relatively flat, and it was starting out at 140 and change. I was thinking it was probably going to be right around 140 and change 2 weeks later at the Jan expiration. That's the reason I chose 140. Turned out I was wrong, and the index shot up quite high and ended up being way beyond that. What if I thought the index was actually going to lose ground? I don't want to do a 140 if I think the index is going to be at 130 because I'm going to be in that left-hand red zone, and I don't want to be there. So in this example, if I thought the index was going to lose value in the near term, I want to pick the strike price that's the closest to where I think it's going to be at expiration. In this example, I think we're going to lose about 10 points in value, so I'm going to do a 130, 130. I'm still bullish long term, but it gives my stock or the index the ability to lose value in the near term, and if it can close right around 130, that works out perfectly for me. The Jan expires, and then that's the point where that's the best point for the Jan to expire and the March to be at its maximum value. Again, my net debit here is 480, so that's my maximum loss, and that's true whether I'm talking about short-term or long-term. I calculate my two break-even prices as my strike price plus my net debit minus the value of my March call, and my strike price minus the value of the March call, and that gives me the two crossover points. At 35% volatility, assuming it stays relatively flat, if I use a pricing calculator, I come out with two numbers of about 120.150 and 140.170, which are what you're seeing on that P&L chart where the green and the red cross over. Now, my long-term break-even, I've got to cover the cost of my total cost of my trade. I'm long a 130 call. In order to cover that, I have to be at least 134.80 at expiration at March, and that's assuming that my January expires worthless. If I lose money on my January, then I've got to get a little bit further down the road. Again, I can let my January expire worthless, and I can sell a Feb. I can buy my Jan back to close it out and sell a Feb if I want to, or I can just offset my losses on my Jan with cash. I can close out the March to cover the Jans. There are a number of different things that you can do. Your maximum gain, however, is going to be at the strike price. So you can use the same pricing calculator. How much would my March 130 call be worth if I was at 130 at the January expiration? Well, I bought the March 130 call for $15.20. It was about $10 or so in the money, so it was about $5 worth of time value. If I let 2 weeks go by until expiration and the index has dropped all the way down to 130, what would be the value of my March 130 call? And the pricing calculator says I would make about $399. And where that's coming from is essentially my net debit for my trade was $480. If I added $399 to that, I'm going to get about $5.79. That is the value that my March 130 call would have on January 20th if AUX was at 130. That's what the pricing calculator can tell me. So even though I paid $15.20 and now it's dropped all the way down to $8.79, I've taken a big loss on the 130s for March, but I made a huge profit on the Januaries because that entire 1040 was expired. So even though I took a big hit on the Marches, I could actually still close out them at a profit because the Marches weren't as expensive as they would have been since I sold the Jans against them, and I only ended up paying $480 for this. So even though the stock goes lower and I'm long calls, I end up coming out making a little bit of a profit. Ideally, again, I want to have the stock be probably right around 130 or maybe just a little lower. And then I hold on to it for the long term, and I could make profit in the long haul. All right, let's move on into it. Yeah, go ahead.
I see a good question. Normally I like to take them at the end, but George has a really good point. And he says, if you use multiple calendar spreads, can you increase your green area? I think he's thinking that at some point you could just buy all the calendars and have all green. Could you just tell him why that probably won't work?
That's a good point. Well, it's kind of like the same thing about like saying, well, if I went out and bought every lottery ticket that was sold and that was available, then I would be bound to win, right? Well, sure, you might win a $6 million pot and you have to buy $7 million worth of tickets in order to do it. It's probably
Right.
not a very good investment, right? So it's a similar idea. There aren't any trades where you can cover all of the potential profit zones without also creating a big, huge list of loss zones that you're going to somehow end up in. So, yeah, you could put on multiple spreads, but you're not going to have a perfect overlap where you've got all green zones and no reds. It's just not possible to do that, and it has to do with the way options are priced. So you really can't do that. Now, you can increase and decrease the size of this green zone by doing a number of different things. You could leverage this spread up by doing a ratio spread where you buy twice as many as the ones you sell. Of course, when you do that, it's going to make it a more expensive trade, and so therefore you've got more risk. There are all sorts of things you can do to modify, but it's not. I've never been able to find a trade yet where I can get all green zones and no reds. Steve, if you do, let me know because you and me, we're going to retire.
Exactly, man. I'm still looking for that. Haven't found it yet. But great answer.
Haven't found it yet. So, all right. So let's move on and look at a second example. So in this case, I was either slightly bearish or neutral on the dollar versus the Australian, and then longer term I was bullish. I don't think either of these would have worked out too well for me in this example, but I think I've got one here where it would have. And the next one I want to look at is the YUK, and that's the dollar versus the yen. The dollar versus the yen index was at exactly 93 on January 9th when I put this spread together. I'm thinking that the dollar is going to gain a little bit on the yen in the near term, but I'm bearish in the long term. So here again, I can structure a spread that has two completely opposite directions, bullish near term, bearish long term. And I can do that just with puts. I don't need to have any calls involved. And the way I do that, again, is here's the key. I guess the simplest way to put this now, if I can just sum it down into two things, is one, first, pick your overall direction. Where do you think it's going long term? If you think it's going higher long term, you do your spreads with calls. If you think it's going lower long term, you do your spread with puts. Secondly, where do I think it's going to be at the date of the first expiration? And then you adjust your strike price based on that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.